A warning to crypto investors. There's always more than one element working together to influence the price of anything. Bitcoin, in contrast to typical financial assets, has always been subject to its own unique set of forces that influence its price. But Bitcoin is not an exception to the basic rule that the price of most assets is heavily influenced by the state of the global economy. People have more wealth available to invest in financial assets when the economy grows, and during other periods when economic success is widespread. In most cases, increased demand results in price hikes. On the other hand, consumers are forced to spend more of their money on immediate consumption during recessionary periods, which decreases demand for assets, such as shares or Bitcoin. Both recessions and expansions have the effect of reshaping the kinds of investments that investors are willing to hold as a result of the changing views and levels of risk tolerance amongst investors. The price of Bitcoin has fallen for a second week, continuing its recent downward trend. Every major index tracked on Wall Street has also experienced a significant decline. President Biden said last September that the COVID-19 pandemic was over, and inflation has been stable for the most recent weeks. If this is indeed the case, the market should be happy, celebrating this catalyst, and have a more positive and hopeful perspective for the foreseeable future. To tell you the truth, it's not quite like that. Despite the fact that the virus is still active, infecting everyone else, the majority of people feel the pandemic stopped a long time ago, when the economy started growing again. The surge in core inflation based on the most recent CPI data has caused investors to be anxious and concerned about prospective inflation numbers. To top all of that, a significant number of current major macroeconomic variables have also had a substantial impact on the market circumstances throughout the year. Hi, I hope you enjoyed my previous video and are happy to be back. Welcome back, or if you're just joining us, we're Finance Bureau, your one-stop destination where we talk about anything related to cryptocurrency and personal finance. I'm glad you could make it. This video will serve as a warning to crypto investors. Let's get right into it, shall we? There are major world events that all cryptocurrency investors should be on the lookout for, and how it can be primary reasons that the markets are crashing over. The Federal Reserve has confirmed its aggressive position on monetary policy while simultaneously increasing interest rates by an additional 75 basis points. The Bank of England has now officially stated that the United Kingdom may be entering a recession, and Vladimir Putin also gave a news conference in which he revealed the most major escalations that have occurred in the conflict between Russia and Ukraine since the crisis first began. To add a little bit of salt to the wound, it would appear that China is also perhaps going to be experiencing one of the greatest crises in the housing market in the near future. There are still some wonderful advances being made inside the crypto industry. Despite all of these adverse events, nonetheless, it appears that the global fund is dominating the markets. Fed rate increase. The cryptocurrency market reacted swiftly, and as was to be expected, to the most recent rate hike announced by the Fed on September 21, 2022, after hiking rates 4 times already this year. It's possible that this won't be the final price hike of the year either. In an effort to curb inflation, which reached 8.3% in August compared to the same month the previous year, the Federal Reserve is likely to hike interest rates many more times this 2022. The likelihood of this happening is strong. In the year 2022, higher interest rates have already begun to have an effect on a variety of assets, including equities, cryptocurrencies, commodities like oil, and many other types of investments. But what should investors anticipate from here on out? And for how much longer will the environment of increasing rates affect markets? Beginning in early 2022, stocks have fallen, and interest rates have risen on speculation that the Federal Reserve will use a series of rate hikes to rein in inflation. Since the beginning of the year, the S&P 500 is down over 17%. The tech-heavy Nasdaq composite is down around 25%, and the Dow Jones Industrial industrials are down around 14%. Investments that were even riskier than these did terribly. Examples of high-growth stocks that have dropped from their 52-week highs include Cloudflare, down 72% from its highs, and Carvana, down 89% from its highs. Bitcoin, the largest cryptocurrency, has dropped by almost 71% from its all-time high in November. The second largest cryptocurrency, Ethereum, has also dropped significantly by around 68%, although it was during a process known as a merge. As investors have factored in increasing rates and higher energy prices, the stock market, cryptocurrencies, and commodities have experienced significant volatility since the beginning of 2022. But with numerous rate increases now in place and more potentially on the horizon, what may be the remainder of this year hold? Less liquidity in the financial markets is generally bad for investments, but investors have a propensity of looking further down the road. A period of stock market volatility is inevitable whenever the interest rates rise. The Fed's signal of several rate hikes suggests a year of sustained market volatility. Opinions differ on whether the stock market has already factored in the possibility of the Fed doing too little or too much. Market volatility is a direct result of this uncertainty. Thus, market volatility is the order of the day for the foreseeable future. Reactions to rising interest rates have been different for two other main asset types. Commodity prices such as oil, wheat, and nickel rose sharply, while the value of cryptocurrencies fell, although these increases were often short-lived. Many people believe that the cryptocurrency is the answer to all of society's ills, including inflation, low interest rates, a lack of purchasing power, and the value dollar, and so on. As long as the cryptocurrency prices were increasing, notwithstanding the performance of other assets, it was easy to trust those positives. When the Federal Reserve declared in November that it would begin reducing its purchases of bonds and warned higher interest rates were shortly to follow, cryptocurrency prices followed the trend of other risky assets and fell. As such, experts suggest you stay the course on your long-term investments, whether crypto or otherwise, and avoid selling when prices dip. You're likely to see steep price drops in the coming months, especially if inflation doesn't improve following the Fed's fifth rate hike. The Russia-Ukraine War. While the price of some commodities may have risen dramatically, in many situations the price has fallen again. As a result of easing supply limitations and rising interest rates, the prices of several commodities have dropped significantly from their previous highs. Wheat prices, for instance, jumped in the days following Russia's invasion of Ukraine, but have already returned to pre-crisis levels. The price of lumber has dropped by more than 50% from its 52-week high, and the price of steel has dropped by a similar amount during the past year. Nickel's price, which more than quadrupled in the aftermath of the Russian invasion, has since settled back down to around where it was a year ago. In spite of the fact that the prices of many commodities have risen sharply and subsequently fallen, those with the greatest demand and the least available supply, such as oil and natural gas, continue to be at or near record highs. On the other side of the coin, cryptocurrency markets have become even more volatile as a result of Russia's invasion of Ukraine, according to technical analysts. One of the many costs of war is its worldwide financial consequences. The human cost is also a major concern for experts. Ukrainian President Volodymyr Zelensky reported on day 2 that over 100 Ukrainians have been killed in the invasion. Many Ukrainians have fled the nation since the invasion, while others have been urged by Zelensky to get ready to protect their homes against Russian troops and attacks. This was during the first few scenarios of the war. If the conflict doesn't end, it will almost certainly result in increased volatility throughout all global financial markets, including cryptocurrencies. As soon as the invasion began, the price of Bitcoin fell below $35,000, and the price of Ethereum fell below $2,400. However, both currencies have increased in value since then, since reaching a peak of $68,990 in November, the price of Bitcoin has fallen by more than 30%. This decline may be attributed, among other things, to current geopolitical concerns in Europe, impending inflation, and the possibility of interest rate rises by the United States Federal Reserve. The price of Ethereum has fallen to its lowest point since late January, coinciding with the general decline in stock markets throughout the world. Investors in cryptocurrencies should brace themselves for further price swings, according to market analysts, because there are no signs that Russian President Vladimir Putin would back down from what President Joe Biden referred to as an act of war on the part of Russia. Because of Russia's aggression on Ukraine, the already high level of volatility that characterizes cryptocurrency markets has been amplified to an even greater degree than before. Crises such as wars usually lead to a crash in the investment market. A crisis leads to uncertainty and panic. People fear that governments and the banking systems may collapse, leading to people losing wealth. Maintaining composure and avoiding impulsive responses to recent shifts in the market conditions is, according to experts, the most beneficial step that investors can take at this time. You should remain committed to your investing plan for the long run. The UK Recession. Because countries all over the world are starting to feel the effects of a global recession, the next few months will be extremely important for the economy of the United Kingdom. As a consequence of this, the Monetary Policy Committee of the Bank of England recently voted by 8 votes to 1 to raise interest rates by 0.5 percentage points in order to combat inflation, which is currently at 10.1% despite a forecast for 2023 that predicts 0% growth and a rising cost of living. Recent revisions to economic projections indicate that the UK faces an extremely challenging future. The country's GDP is expected to decline by more than 2% later in 2022, according to current policy predictions. Meanwhile, in 2023, the US and the Eurozone can look forward to respective projected growth of 1.5% and 1.7%. However, a government spokesperson pointed out that the UK is not alone in facing slow growth, with Putin's illegal invasion of Ukraine and weaponization of energy presenting a global challenge for economies across the world. The price of Bitcoin fell below $20,000 for the first time in less than a week. This occurred as news of record inflation in the United Kingdom and fears of a recession struck cryptocurrency markets. Since the first quarter of this year, investors' enthusiasm for cryptocurrencies has waned, with 33% of respondents stating that they want to sell some or all of their cryptocurrency holdings. In the first quarter of 2022, this figure was just 11%. It's not entirely unexpected, especially in light of previous market collapses and the extraordinary volatility of the cryptocurrency markets. This is some proof that despite cryptocurrency's early promise as a substitute for gold as a hedge against inflation, it may not offer the desired security to some investors. Though it is hard to foresee exactly how the following months will play out, indications of an impending recession would definitely scare investors. Investors should remember that risk management will be of paramount importance for the remainder of 2022 and likely well into 2023, even if the present economic environment still provides some chances. If you expect your portfolio to be hit by a subsequent downturn, you should prepare accordingly. If you want to know more about managing finances and investing during a recession, you might want to check some of my videos about them on this channel. The bottom line. The bottom line is that we do not have any influence or power over the events that are currently happening in other parts of the world. Our response to it, on the other hand, is something we have complete command over. It is a useful reminder that crypto assets are incredibly volatile, even though there are probably not any urgent adjustments that crypto investors need to make in response to this. Because of this, financial advisors recommend that most investors focus their attention on the top 2 cryptocurrencies, Bitcoin and Ethereum, and invest no more than 5% of their whole portfolios, or just the amount of money that they are willing to lose. Investing in cryptocurrencies should never take priority over other important aspects of your personal finances, such as putting money aside for your emergency fund, paying off debt with high interest rates, and saving for retirement. Stick with a major high-volume cryptocurrency exchange, such as Coinbase or Gemini, that proactively complies with growing federal and state regulations when it comes to buying and trading Bitcoin. What have you gathered so far? Let me know in the comments section. If you believe you have gained anything from this video or enjoy this type of content, please make sure to give this video a thumbs up and subscribe for more information about personal finances or the world of cryptocurrency. Thank you so much for watching. We'll catch up with you at the next one.